Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the topic of analyzing the financial statement, which is topic 7, and the last topic in FRA. So in this session specifically, I want us to do an illustration question, and the question I want us to do is a question which was tested in the sitting for 2021, specifically question number 3. Let's go through the question and we see what was required. So question 3 of 2021, December 2021 reads, various analytical tools are today utilized in financial statement analysis. Some of these tools include number 1, ratio analysis, number 2, trade analysis, and number 3, common size financial statement. Required in context of the statement above, describe how each of the above tool is utilized in practice. So we are given the various analytical tools, and what the examiner there was requiring is we describe, or basically we explain how those particular tools are used in what? In practice. So this is part A, which require explanation of various analytical tools, or we can just talk of explanation of financial statement analysis tools. So in that case, you're given a number of tools which are required to explain. The first one is ratio analysis. And for the ratio analysis, this particular tool here, or technique, it basically entails computing various financial ratios. And in our case, we know a financial ratio is a relationship between two or more financial variables. So therefore, you can say this entails computation of financial ratios. And also we have various categories of ratios which we discussed in our first session as far as this topic is concerned. So the other tool we are required to explain is the trade analysis, which is also known as the horizontal analysis. Now, horizontal analysis, which is also known as a trade analysis, is basically analysis which is done or undertaken by a financial analyst to establish the trade, or in other terms, to establish the change, which is the increase or decrease of the various financial statement items as compared to a certain base period. So therefore, you can say that this entails establishing the trade. So in this case, the trade is the same with the change, and this change can either be an increase stroke decrease of various financial statement items, in a certain financial period, or in a certain year, as compared to a base period, as compared to a base period. For example, in this case, you can be given the income statement which was prepared by the company in the year 2023. You are given various items of the income statement. For example, maybe you can just pick one, and that is revenue. You're given the revenue of the company for this year. But equally, let's assume that you're given the revenue for 2 years, not 1 year, revenue for 2 years, 2022 and 2023. So in doing this particular analysis here, which is known as the trend or the horizontal analysis, we are saying what we need to do is to establish the trend, or basically the change, that is the increase or decrease of financial statement items in a certain year compared to a certain base period. So what we do here, assuming you're given the revenue here to be 200 million, here to be 250 million. So we have an additional column here whereby we show the increase stroke the decrease, the increase stroke decrease, and this increase or decrease will be for the most recent financial year, which is now the year 2023. And in this case, we can see the revenue for this year increased with 50 million compared now to the revenue for this year. So basically what that means is that the year 2022 will be recognized as the base period. That is the year we are using to determine whether the revenue for 2023 increased or did what? Reduced. After showing the increase or decrease, basically an increase you record it as a negative, but if it was a decrease recorded as a negative, it must be inside the bracket. And then finally, you have to express that increase or decrease as a percentage. You express that increase or decrease as what? As a percentage. For example, in this case, you take 50 million, divide that with the revenue for the base period, which is the 200 million times 100. And in this case, we can make a conclusion that the revenue for this year increased with 25% as compared to the revenue for 2022. That is now what we refer as the horizontal or the trend analysis. And basically, you repeat the entire process for all the items of the financial statement. So then we also require to explain the other tool number 3, common size financial statement. Common size financial statement. These are the financial statements which are prepared by expressing all items in the financial statement as a percentage of a certain base item. So here, all items will be expressed as a percentage. So we can say these entails expressing all items in financial statements as a percentage of a certain base item, as a percentage of a certain base item. And here we have number 1, the common size income statement. So common size income statement, this one, entails we express all items in the income statement as a percentage of revenue. So all the items in the income statement here will be converted, or basically will be expressed as a percentage of the revenue, or basically as a percentage of what? Of sales. As a percentage of sales. And then we have the common size statement of financial position. This one entails, or this one is prepared by expressing all items as a percentage of total assets. As a percentage of total asset. So therefore, that's what you mean by common size financial what? Statement. And that's what was required as far as Roman 1 of that question is concerned. And the marks which were located there were 6. So basically what that means, that explaining each of these, you are getting 2 marks. 2 marks for explaining each of those particular what? Concept or those particular analytical tools. So let's move to part B of that question. And it reads, summarize 4 attributes of a good financial statement analysis. So the examiner here was asking about the attribute, or in other terms, the qualities of a good financial statement analysis. So let's explain those attributes. Attributes of a good financial statement analysis. So these are, in other terms, are qualities of a good financial statement analysis. And I think in our previous session, we discussed on this. We have around maybe 5. We can talk of number 1, timeliness. Timeliness. And in this case, we say that the information which is provided by financial analysts, it has to be provided on time to help the users in terms of making decision. Number 2, we have understandability. Equally, the information provided by financial analysts must be readily understandable by the users for the users to use that information in terms of making their intended decision. Then we also talked about the reliability, and we said this information provided by financial analyst, one, must be complete. It must be what? Free from any errors, and also it must be what? Neutral. We also have relevance, meaning that the information provided by financial analyst must influence the decision which will be made by the users. Must influence the decision which will be made by who? By the users, and so on. So I think the examiner there was just requiring 4. We can just talk of those particular word 4 attributes, and equally the marks which were located there were for basically for explaining it. You get those particular or for explaining those 4 attributes, to get a total of 4 marks. So let's move to part C of that question, and it reads: the following are extract from financial statement of from the books of Zawadi Limited. We are given the extract of the income statement for 2 years, 2020-2021. We are given the sales revenue. We are given the cost of sales, which are told approximate purchases. We have the gross profit, administrative expenses, distribution cost, profit, or we have the finance cost. Then we have the profit before tax. We have the extract of a statement of financial position, where we have non-current asset, which include property, plant and equipment, intangible assets. Current asset comprises of inventories, trade receivables, cash and cash equivalent, and then we have the total asset. We have then the current liabilities, which include trade payables, current tax payable, and then we have the total current liabilities. Then we are told to assume a 365 days financial year. From that information, the examiner was requiring we analyze and interpret the performance and efficiency of the company for the 2 years, the year which ended 30th April 2020 and 2021, using the following ratios. So in other terms, what the examiner was requiring is we compute those 5 ratios and we comment on the company's performance and efficiency over the period of 2 years, that is 2020 and 2021. So therefore, let's compute those ratios. This is part C of our question, whereby we are required to compute a number of financial ratios, and we are required to compute those ratios for 2 years. For 2 years. So we need to have like 3 columns here. The first column will be for the ratios we are expected to compute. Then we have our 2 financial years. We have 2020 and 2021. So always make sure the first year comes first for you to be able to see the trend. So the first ratio we are expected to compute is the gross profit margin. Gross profit margin. So the first thing you have to recall here is the formula. How do we compute this? We take a gross profit, we divide that with the revenue times 100. So that's how we compute that ratio. So we go back to the income statement or the statement of profit or loss. This is where we get the information about revenue and the gross profit, actually from the income statement. So the gross profit for the first year is 103,812. We divide that with the revenue, which is 476,200 times 100%. And then for the other year here, we have the gross profit, which is 117,902, divided that with the revenue, which is 701,800, and we definitely have to multiply that with what? With 100. So let's compute these two ratios here. We see what we are going to get. So the ratio for the first year is 103, 812 divided by 476, 200 times 100%, and that will give us 21.8. 21.8%. What about 2021? We have 117,902 divided by 701,800 times 100%. That is giving us 16.8%. 0.8%. So let's move to the other ratio number 2. Number 2, or Roman 2, we are required to compute the other ratio, which is return on capital employed, or LOCE. Roman 2, return on capital employed. This one is computed by taking, we compute this by taking PBIT, profit before interest and tax. We divide that with capital employed times 100, in terms of how we compute the capital employed, this one is computed by taking the total asset minus current liabilities, or alternatively you can take equity plus non-current what? Liabilities. So, but let first of all we get the profit before tax. The profit before tax, in other terms, is also known as operating profit. You get that from the income what? Statement. But in most of the cases, the examiner will not have given you this. Like if you check on the information which you are given in the income statement, there is nowhere we are given the profit before what? Interest and tax. Interest and tax. So what we are given by the examiner is the profit before tax. The profit before tax. So how do we arrive at the profit before interest and tax? So we take this profit before tax and then we add interest. The interest is the same with the finance what? Cost. After adding the two figures, we are going to have the profit before interest and tax. So let's do that. We take the profit before tax, 50,850, and then we add back interest, or the finance cost for that year is 7,200. That now will give us the profit before interest and tax. We divide that with the capital employed. The capital employed, I've said, you can take the total assets minus current liabilities, and actually that is the formula we are going to apply here. We take total assets. Total asset will be equal to non-current asset plus current asset, which is 10, 18, 140 plus current assets. Current asset 236, 695, and then to this we less current liabilities. Current liabilities is 179, 835. That's how we are going to arrive at the figure for capital employed. So we do the same for 2021. We take the profit before tax, which is 42,960. We add the finance costs, or the interest, which is 10,800, and then we multiply that with 100. We divide that with the capital employed, which will be equal to total non-current asset 1881, 500, plus current assets, which is 335, 500, minus current liabilities 297,000. Yes. So this ratio is very, very common, because you can see none of these two items, the profit before interest and tax and capital employed, is provided to you by the examiner. You have to remember the formula for computing those two what? Items. So let's compute those two, or basically compute the return on capital employed for the 2 years. So we start with the first year here. We have 50,850 plus 7,200. That will give us 58. We can write it here, 58,050. And then we have the denominator 10, 18, 140 plus 236, 695, minus 179, 835. 835. So that will give us 107. Okay. So what we need to do, we take 58,050 divided by answer times 100%, and that will give us a 5.4%. What about the other year here? We have 42,960 plus 10,800, 10,800 that is, and then we divide that with 1881, 500 plus 335, 500 minus 297, 1,000 times 100. That will give us 2.8%. 2.8%. So that's how we compute that figure for what? For the return on the return on capital employed. So let's move to the other ratio, number 3. Number 3, we have inventory turnover period. Inventory turnover period. So the inventory turnover period, this is a ratio generally which is computed to determine on average the number of days this company was taking to convert inventory into sales. So how do we arrive at this? So we take the average inventory, we divide that with the cost of sales, and then we multiply that with the number of days in a year. So in our case, we are told to assume a year has 365 what? Days. So how do we compute the average inventory? So we compute the average inventory by taking the opening inventory plus the closing inventory divided by 2. But we only compute if you're given a question and you're given 2 financial years like what you're given here, 2020, 2021. You only use the average figures if the examiner has provided you information or has given you the opening inventory for the first year. If you are not given that opening inventory, then for the 2 years, you use now your closing inventory as your average. So meaning that you only compute now the average in the event you're given the opening inventory for the first what? Year. If it's not given for the 2 years, then you use your closing inventory as your average. So we have the closing inventory under the current asset. In the first year, it is 81,000 times 365. And then the other year here, we have 81,400 times 365. And then we need to divide that with the cost of sales. Cost of sales, we get that from the income statement. We have 372, 388 for the first year. And here it is 583, 898. So let's compute this particular ratio here. So for the first year, we have 81,000 divided by 372, 388 times 365. So that to the nearest whole number will give us 79 days. 79 days. What about the first year? 81,400 divided by 583, 898 times 365. That to the nearest whole number will give us 51 days. So these are ratio computed to show on average the number of days the company was taking to do what? To make sales or to convert inventory into sales. So the other ratio, which is number 4, as the trade receivables correction period. So how do we compute this particular ratio here? So we take the average trade receivables, we divide that with the credit sales or the credit revenue. Credit revenue, we multiply that with this 365 what? 365 days. And equally here to compute, to determine the average trade receivables, we take the opening trade receivables plus the closing trade receivables divided that with 2. But equally, we only compute the average in the event the examiner has given you the opening receivables for the first year. So in such a case whereby you're given 2 years, but if you're not given the opening receivables for the first year, what you do, you then use the figures in the statement of financial position as your average. That will be the case in year 1 and also year 2. So where do we have the receivables? The receivables, we have them in the statement of financial position, specifically other current assets. So for the first year, we have 95, 240. We multiply that with 365. The same case with the other year. 175, 450 times 3 what? 65 times 3, 65 times 3, 65. We divide that with the credit sales or the credit revenue. Equally, if you check on the income statement, what the examiner has given us is revenue. And unless told otherwise, always you use the revenue in the income statement to be on credit. To be on what? Credit. There are some cases whereby the examiner may have given some information that the revenue of the company was 70% of the total revenue. Unless such information is given, you assume the entire revenue was on credit. So the credit revenue for the first year is 476,200. For this year, it is 701,800. So we compute these particular ratios and we get the final figure. So let's start with the first year, which is 95, 240 divided by 476, 200 times 365. So this will give us 73 days. And then in the first year, we have 175, 450 divided by 701, 800 times 365, which will give us 91 days. 91 days. Yes, so that is it. That what is required there. And then finally, we have the other ratio, that is the trade payables payment period. Okay, so let's just have it here. Trade payables payment period. So how do we compute this one? We take the average trade payables times the number of days in a year, 365, and then we divide that with the credit purchases. Credit purchases. In the event the examiner has not given you the credit purchases, what you do, you instead use now the cost of sales. But if you check on what you're given in this question, we are told in the income statement the purchases, or basically the purchases of the company were the same with the cost of sales. So therefore, let's compute this ratio. So we take the average trade payables. Average trade payables equally, we take the trade payables at the start plus the closing, and then divide that with 2. But equally, the concept I've explained here, for receivables, for inventory, we only compute the average trade payables where the examiner has given you the opening payables for the first year. If that is not given, then in year 1, year 2, use the figures in the statement of financial position as your average. We know trade payables is part of the current liability. So this is 111, 715 times 365. Here we have 204, 365 times 365, and then we divide this with the cost of sales or the purchases, which is 372, 388, and then here we have what? We have 583 898, and then we get the final answers here. Yes, so let's compute those final answers. We start with the year 2020. We have 111, 7115 divided by 372, 388 times 365. So that will give us 109 days. 109 days. And then finally we have 204, 365 times 365 days divided by 583, 898. So this will give us 128 days. 128 days. Yes, so that is it. That basically what was required as far as that question is concerned. And by computing those particular ratios, for each ratio the examiner was had allocated 2 marks. So meaning that by doing that you get 2 marks, 2 marks, 2 marks here, and equally there you get what? 2 marks. In total, there were 8 what? There were 8 marks for computing those ratios. But you can see, as far as the computation of ratios is concerned, what is important is for you to remember the formulas. If you can't be able to remember the formula for computing these ratios, then there is no way you can be able to successfully attempt and also pass a question on computation of what? Of ratios. So that is it. That what was required as far as that question is concerned. I want to give an assignment which I expect you to attempt, and the question or the assignment is a question which was tested in the April of 2022, specifically question number 2. Question number 2. This is a question which was requiring the computation of what? The computation of ratios. The computation of ratios. Once you attempt that question, I usually encourage all my students to get these revision partners by manifested publishers. Is updated up to the latest sitting. So therefore get this. Once you attempt the question, you have any challenge in terms of answering that question, you'll be in a position to access all the solutions at the end of this particular book. So therefore, make sure you also have this particular revision kit with you. So that brings us to the end of that particular session. So once we come back in our next session, I want us to look on an illustration question which was tested in the sitting of August 2022, which was requiring the preparation of the common size financial statement.